Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
Hello,
All right. All right. Happy Monday.
Yes, sir. Happy Monday.
Lots of activity over the weekend. I had a bunch of contracts come in. 2 of them were from out of state. So things are happening. People are moving around. I got some buyers buying up in the Carolinas and Georgia for second homes and vacation homes. And
Wow.
yeah.
Yeah, very good. Yeah, I've actually seen DSCR rates come down quite a bit recently.
Well, I think that all rates have come down a little bit, and I think we should talk a little bit about that.
Well, yeah, let's do that because we have a big event that's an event, but it's a non-event at the same time, right?
Yeah, you mean the Fed cut rate?
Yeah.
Listen, I think everybody could expect that when this Fed cut interest rates, all interest rates are going to drop by 0.5%.
Well, come on. Well, actually, they will from a month and a half ago. Right?
All right. So let's be realistic about this then, because the Fed will be cutting the Fed rate. It's probably a good chance it'll be 0.5%. I think that they've really moved in that direction, which it'll take them a few months before they start to feel that effect. But what I don't think a lot of folks realize is that money is already baked into today's pricing. Listen, rates are already down a point from what they were 2 months ago, a month and a half ago.
Exactly.
So things are looking a lot better and more people are jumping in the market now.
Yeah, I agree. I mean, and sales is showing that as well. I'm looking at some data here, and we have sales.
Show that on the screen.
Yeah, I think I can do that.
And so then we can also look at the bond market that I have up, and I can show you where rates were and what they're going to look like. All right, let's look at what we have here. That's a little small for me to see, but
yeah, sorry about that. It's, I got what I got, right? So, let's see if we can make it a little bit bigger. There we go. So, yeah, you see like closed sales is, kind of flat, but it's up 1% from last year. Same, month over month, right? That's July. Cash sales is way down. So what that tells me is that your investor class is not buying near as much, right?
Not in cash anyway.
Not in cash, right? Exactly. Median price is up, but I think that, and average price is up as well, but I think there's an anomaly there. And I've got some good data to back it up. I don't have the data to share and show it, but the concept is that about the same amount of $1 million plus homes are selling and less $1 million and under homes are selling. So the average or median are both up, but meanwhile, the price of the average home really isn't. They're actually a little bit down, about 2 to 3% down from what they were 2 years ago, not last year, but 2 years ago. But anyway, median list price or median sale to list price is actually down, which tells me that sellers are trying to get the higher prices, and they're actually cutting the price to get the deal. And what this misses, what this misses is a lot of people don't realize this isn't to the original list price. This is to the last drop.
Right. Well,
so it is original list price, but it's really not.
If you're a seller and you're not getting realistic on your price and your concessions to the buyer, then you're making a mistake, because right now there's more houses on the market than we've had in 10 years. I mean, our inventory's way up. Well, what does that mean? What does that mean? It's simple. It means that we are truly into a buyer's market, whether the industry calls it a buyer's market or not. When you have that much inventory and less buyers than sellers, then you're going to turn that into a buyer's market. And I think it's perfect opportunity with rates being down. And that's probably why I'm seeing more buyers jump in the market. And I'm seeing more people looking at refinancing in the market. VA
Absolutely.
loans, FHA loans, streamline refinances, and all these folks think that they should be going to USAA if they're a veteran. Don't go to USAA. I get you a better deal right here. Listen, rate reduction refis, in my opinion, need to be on hold for about another month to 3 months. Because if you're a veteran and you refinance right now on a rate reduction refi, you have to wait 241 days to do it again. So do you want to do it again and then hope that rates are down in another 241 days? Or do you want to just wait it out another 3 or 4 months and then try to get the best you can? Now, most lenders don't want to tell people that. They don't want to tell people that because they want the deal right then and there. On the other hand, I want the right thing for people. So I've created a watch list so that when a rate hits a certain target, I can lock it in for that client.
Gotcha. Yeah, that's great. That's good to know. Yeah. So, I mean, look at, you talked about inventory. Average inventory is up, or active inventory is up 60%. We're up
Yeah.
to
What do you got? 11.5?
This is just single family homes in the Orlando Kissimmee MSA. This is not our overall market. This is just single family homes, and it's just in the Orlando Kissimmee Sanford MSA.
Yeah.
And we have about 3.6 months of inventory, which is not a buyer's market, but it is a buyer's market because sellers got so used to their house selling in 5 days that they just think anything over a week is a horrible thing. So,
it's so funny because if we look at the data, it would tell us we're still in a seller's market, but the behavior and the opportunities are definitely a buyer's market. It's just like the president coming out and saying the economy's better than it's ever been. It's unbelievable economy right now, but the average household is going, I'm not really feeling it.
Exactly.
So it's you have to take away all the puffery and really dissect what the market really is. And I'm telling you, it's behaving like a buyer's market to me.
It sure is. Hey, you were going to share some data on.
So I just want you to look at the bond market for me for a second. Now you have to remember, folks, that your mortgages are not tied to the Fed rate. They're tied to the 30 and the 10-year bond market. So here we've got the Fannie Mae 30-year bond market. Now, we want bonds to be up. The higher the yield, the lower the rate. So this is when we were in the high sevens. And then, we got better, we got worse, we got better, we got worse. But you can see what the trend is. So we are looking much better right now for interest rates. So that puts the Fannie Mae rate at 5%, which would mean your average rate's probably around 1 to 1.25% higher than that. Now, granted, I'm locking loans in at 5%, 4.95 with some buy downs. And I don't mean temporary buy downs. I mean permanent buy downs. So some of my builders are paying, ample closing costs. I'm recommending sellers do it as well, so we can really make these interest rates very attractive for people.
So wait, you're telling me that right now you're writing loans that have a 5% rate, APR?
That's correct.
Okay. And then what is because they're going to be paying a point or whatever.
They're going to be paying more than 1 point to get down to that. But
right.
What's
the yield then? What's their actual, effective rate?
Well, their effective rate would be whatever the note rate is that we locked. And APR just takes into consideration the overall closing costs added into the rate. So forget APR when you got a seller paying the closing costs, because your APR is your APR. I'll give you an example. If I loaned you $100 at 10% interest rate, what's your interest rate?
10%.
What? 10%. Now, if I loaned you $100 at 10% interest rate, but I charged you $10 in fees, okay, what's your interest rate still?
20%.
No, it's not. It's still 10%.
I
It's
know my
still,
interest rate's still 10%, but my
but,
actual
but
effective rate.
your APR may be 11. Now, if I charged you $10 for fees, but we had another party pay those fees for you, so you only really paid the interest, then your APR and your interest rate are effectively the same.
Yeah, yeah, I understand that. It depended on who paid it. It just, I guess it all depends on where that money goes. While it is easier today to get a seller to pay closing costs and other things, there's only so much milk you can get out of them. And, now we have this new thing with the NAR settlement where the buyer's agent commission is now a negotiable item. And sellers look at that as a concession as well, or they're
I
starting
always
to.
thought it was.
Well, it was and it wasn't, right? It was kind of predetermined ahead of time. It's kind of like when you're looking at an item and you decide you want it, and then you go up to the register and you find out it's 7% more. You're still okay with it, right? And so it's the same thing with the sellers. They knew they were paying a percentage, and then they would either negotiate or not negotiate closing costs. But now when they're presented with closing costs, it's like, well, hey, listing agent, why don't you take a smaller percentage? Or I'm not going to pay the buyer's agent as much. So there's a little more conversation around that, which I think I like it. And I like it because it gives us as agents, buyers, and sellers more flexibility.
Well, and also you have to be a good agent. You have to be able to show your value and why you are worth that much commission. But most
Absolutely.
of the listing agents that I know of, they won't even take a listing if the seller isn't willing to pay the buy side, because
Yeah.
we need buyers. What's the point? You can have the best product in the world, but if nobody ever sees it, then nobody's going to come buy it.
So yeah, I have a different view on that. First of all, I think with taking a listing where the seller refuses to pay it is one thing, but most sellers that I've talked to that don't want it predetermined ahead of time, they're willing to do it, but they want to see what the offer is going to be. And so while they might give 3% to the buyer's agent, they might not give 3% to the buyer's agent and 6% to closing costs. They might want to negotiate both.
Yeah, but that's always been negotiable.
Oh no, it's been tough to do because it was predetermined ahead of time on the listing. The listing agreement said the seller was going to pay this much. And so while yes, you could always go back and modify it, it was kind of predetermined. Like I said, I think it's good overall. I think it's good for the industry. I think it's going to weed out some of the weaker agents because they're not going to be able to operate. And it's going to be give sellers and buyers more flexibility to come to terms. Since the agreement, I've had several deals closed where my buyers came out of pocket with $2,000 or less. You can't even get into a freaking rental for that.
No, you can't.
And I still got paid my commission. So everybody wins. So
absolutely. So listen, the point is interest rates are down. There's a lot of homes on the market to choose from. Sellers are still willing to negotiate.
100%.
If you're looking to buy a home or refinance, now's a really good time to do it. Just give Tom or I a call. We'll be happy to help you.
Happy to help, man. Bruce, you have yourself a great week. I will be talking to you